This presentation is Introduction to Federal Income Tax Law for the tax year 2020. The topics that we're going to discuss today are tax law basics. We're going to look at various types of income, various types of deductions, and also credits. We're going to look at what's the difference between a deduction and a credit. We're also going to look at the 2020 Form 1040, both pages 1 and 2, and schedules 1 through 3, which pretty much makes up the 1040 form. There are many other schedules, of course, and worksheets that go along with the 1040, but we're really going to focus on just the core, which is the 1040 itself with its 3 schedules. We're also going to look at available training materials so that you can get up to speed on the various tax law issues. So the basics of United States tax law. First of all, the basic, getting about as basic as you possibly can, all of the income that a person receives is taxable in the United States, unless, of course, the law says that it is not. And no deduction is allowed unless the law says it is. No credit is allowed unless the law says it is. So that gets down to the nitty-gritty, the very basics of it. Let's talk a little bit about simple calculations on the front page of the 1040. First of all, gross income. How do we calculate adjusted gross income? So if you take gross income minus any adjustments to income, and there's a section on we'll look at the 1040 itself and see that there's a section called adjustments to income. Then you get the adjusted gross income, the AGI. Then if you subtract out the tax deductions, which could be either itemized deductions or standard deductions, you'll come up with the taxable income. So that's simplifying as much as possible the tax calculations. So with respect to U.S. tax law, there really are only 2 types of income. There's taxable income and there's non-taxable income. And under each of those categories, there is what's called earned income or unearned income. So there's taxable earned income, there's taxable unearned income, there's also non-taxable earned and non-taxable unearned. So taxable income must be reported and is also subject to United States tax, federal tax. Non-taxable income may need to be reported, but is exempt from tax. So in some cases, non-taxable income does have to be reported because it plays into other calculations in the tax law that don't necessarily relate to taxability or not. What are some examples of earned income? Well, earned income can be income that's received from wages, self-employment, long-term disability payments prior to the minimum retirement age, or even the strike benefits that come from unions. Let's look at some examples of unearned income, which is generally income that's not produced from work. So we have unemployment compensation, which is an example of unearned income, interest and dividends, capital gains, Social Security benefits, retirement income, rental income on Schedule E. Now, scholarship income can actually be either earned or unearned depending on what it's being used for. So for determining somebody's filing requirements, it's considered earned income. And also for purposes of the standard deduction, it's also considered earned income. But otherwise, it's considered unearned income. So it kind of plays both roles. Alimony, it can, in many cases, be taxable or not taxable. We'll get into that once we get into learning the tax law. But alimony can sometimes be taxable and other times be not taxable. But if it is considered taxable for a particular individual, then it's considered compensation for purposes of determining their ability to contribute to an IRA. Adjustments and deductions. Adjustments and deductions reduce a taxpayer's taxable income. There are two categories on the 1040. The first is adjustments to gross income. So there will be a list of things on the 1040. We'll look at those in a few minutes that are listed as adjustments to gross income. The second category is deductions. They can be either itemized deductions or they can be the standard deduction. These days, the standard deduction is far more popular, especially with married couples. The standard deduction is quite generous, so within the last couple of years, taxpayers have been finding it difficult to actually itemize enough deductions that would surpass the standard deduction that they're being allowed. So we're seeing more and more standard deductions, fewer and fewer itemized deductions. And for purposes of tax preparation, itemized deductions really can be very time consuming for the preparer. So standard deduction is far more beneficial and far easier to do than the itemized deductions. So you'll see that later on. Now let's talk about credits. There are two types of credits. First of all, a credit being different from an adjustment to income or from a deduction. A credit really reduces the tax liability dollar for dollar. Now, what does that mean? What's the difference between an adjustment to income and a credit? What does dollar for dollar mean? So if somebody receives a credit, let's say that somebody has a tax liability of $1,000 and they receive a credit, let's say for child care or for some other, there are many different credits that we'll get into later on, but if they receive a credit that's $1,000, then their $1,000 tax liability is completely wiped out by the credit. So they owe nothing. Now, an adjustment to income, on the other hand, is based on your effective tax rate. So if somebody had an effective tax rate of, let's say, 5%, and they reduce their income by $1,000, then their effective gain from that adjustment to income is really only going to be $50. So it's not dollar for dollar, it's only 5% of the $1,000. So it's a huge difference. So if somebody has a choice of taking an adjustment adjustment to their income or taking a credit, then the credit is always the choice because it's dollar for dollar. So let's talk about the types. There's a non-refundable credit and a refundable credit. A non-refundable credit is limited to tax liability. It cannot reduce tax liability below zero. So a non-refundable credit, let's say that somebody had tax liability of $1,000 and they had a non-refundable credit of $1,500. They would not get the full $1,500 as a credit. They would only get $1,000 because you can't reduce the tax liability to less than zero. On the other hand, a refundable credit can reduce the tax liability below zero. I'll give you an example of that. Single parents who have young children, and 2 or 3 children, let's say, may have no taxable income at all. So they have no tax liability. However, they do qualify for the earned income credit, which could be thousands of dollars. Usually, I'd say the average is probably around $3,000 that they would qualify for, and they would receive that regardless of whether they had tax liability or not. So that's probably the prime example of a refundable credit. There are certainly others, but earned income credit is kind of the more common one. Now we're going to take a look at the 2020 1040, and we're going to look at the section on the 1040 for filing status, person's identity, taxpayer's identity, and dependents, the income and adjustments and tax liability section, the additional income and adjustments on Schedule 1. We're going to look at Schedule 2, additional taxes, and the non-refundable credits and refundable credits found on Schedule 3. So here's the first part of the Form 1040, the top of page 1. The first thing we have there is filing status. You're going to have considerable training on determining filing status. Filing status in some cases can be very simple to determine, but in other cases can be quite challenging. So that's a major part of the training that we're going to be providing to you is determining filing status. That'll happen probably after the second week. You'll have training on that. So you can see where the basic information of the taxpayer needs to be filled out in that top section. Their social security number, their first and last names, addresses, etc. Beneath that, you see virtual currency. Virtual currency, things like Bitcoin, for instance, are getting more and more popular one year to the next. And certainly with the senior population, they haven't had much exposure at all to virtual currency. So it's probably not going to be very prevalent in any of our sites. But as time goes on, virtual currency is being used more and more in our country. And so as tax preparers, we need to be aware that people could potentially have income in the form of virtual currency and that it is in fact taxable. So we have a couple of questions on the intake and interview form that have questions that ask specifically about virtual currency and whether you received any income in that form. And so we certainly have to find that out. And then you need to talk to your local coordinator if you find that somebody does have virtual currency income. The local coordinator can possibly determine that it might be out of scope for that particular site, or maybe something that we could handle. We're probably going to get more involved in learning more about virtual currency and how to handle it. So I'm not going to spend a lot of time on it right now. Down at the bottom, you see the section for dependents. So this is where the taxpayer's dependents will be listed. And we're going to move on to the bottom of the next page. Here's the bottom of the 1040, bottom of the first page. And you can see here that this is the section for income and adjustments, as we already spoke about. So there are lots of different income and adjustments. And you can see also here on line 12, standard deduction or itemized deductions itemized deductions come from Schedule A. So if there were itemized deductions, there would be a Schedule A, otherwise there would not be. So you can look at the various things here. Some of them are very common, like your IRA distributions, pensions, Social Security benefits, charitable contributions now appears on the front of the 1040 for the first time in 2020. Charitable contributions used to only be on the Schedule A, itemized deductions. But last year, Congress, since fewer and fewer people were being able to use itemized deductions, Congress determined that it would benefit the average taxpayer to be able to claim some of their charitable contributions on the front of the 1040. And in 2020, they can claim $300 per couple. And in 2021, they'll be able to deduct $300 per individual. So we're looking forward to that. Now we go to the top of the 1040 on page 2, and we look at the tax liability. So the very first line, line 16, tells us what the tax is on the income that was listed on the front page. Then we get down into the payments and refundable credits section. So we can see the total tax on line 24. We can also see federal income tax withheld from W-2s or 1099s. So now we're looking at what did the taxpayer actually pay toward their tax liability. The W-2s, 1099s, other forms. Also, if the taxpayer had made estimated tax payments, quarterly estimated tax payments, they would show up on line 26. And then refundable credits, the big one being earned income credit on line 27. And again, a refundable credit is a credit that somebody would get the entire credit regardless of whether they had tax liability or not. Then we can see the refund on line 35A, And you can also see that there's a place for bank information if they're doing direct deposit. Now, typically we don't see any numbers in, we'll see a bunch of X's in the routing number and the account number when it comes to the tax return, because the only time the numbers actually show up there are after the tax return has actually been electronically filed. So for purposes of working in the tax season, when we look at a PDF file of a tax return, we generally don't see the routing number and account number, even though they have probably been entered into the software. They don't show up on the actual copy until the tax return has been e-filed. And then we can see that if somebody had a balance due rather than a refund, that would show up at the bottom on line 37. And then if they filed late for some reason or didn't have enough tax paid in advance, they would pay a penalty, and the penalty would be listed in line 38. This is the first of the three schedules, Schedule 1. And this schedule is primarily devoted to additional income and adjustments to income. So Part 1 and Part 2, additional income, and Part 2 is adjustments to income. So some of the things that you'll see under additional income are alimony received. You also see business income from a Schedule C, other gains and losses, rental real estate, farm income, unemployment compensation, all of those are under additional income. In adjustments to income, we have educator expenses, which are used by teachers, certain business expenses, and health savings account deduction. So when you put money into a health savings account as an employee or as a self-employed person, you'll get credit for that as an adjustment to income. Deductible part of self-employment tax. So self-employed people do get a part of their self-employment tax gets paid back to them, and that shows up here. Alimony paid is also an adjustment to income for the payee, for the payor. And then you also get a deduction for IRA on line 19. So money that you put into an IRA on your own, not through your employer or anything, something, if you open an IRA at a bank and you put money in yourself, you get a deduction on the Part 2 of your Schedule 1, and that in turn affects your taxable income on your 1040. Schedule 2, additional taxes. Part 1 is tax, Part 2 is other taxes. So Part 1, these are especially probably younger taxpayers that would have alternative minimum tax. There is something called alternative minimum tax, which we have very little contact with, but AMT, as it's called, affects some people that have huge itemized deductions, for instance, sometimes can be affected by alternative minimum tax, but we don't see it in our population very much at all. Also on line 2, excessive advance premium tax credit. So this is a situation with the Obamacare, for instance. People that were paid excessive amounts of premium tax credit would have to pay it back here. So this is an additional tax that they would have because they received too much in the premium tax credit in the first place. Then we have Part 2, other taxes. So here you'd see self-employment tax for those people that are self-employed and have Schedule Cs. And additional tax on IRAs for people that maybe had taken money out of their IRA before age 59 and a half. This is, some tax preparers actually look at this as a penalty. They call it an additional tax, which makes it sound a little less of a burden, but in fact it is a penalty. People take money out of an IRA before 59 and a half, they pay an additional 10%. So it's a pretty hefty fee. And then the rest of these things we see very little of on here, so I'm just going to skip to the next schedule. Schedule 3, additional credits and payments. Here we have non-refundable credits such as the foreign tax credit, credit for child and dependent care expenses, educational credits on Form 8863 would show up here, retirement savers contributions. So all of these we have quite a bit of exposure to. We see most of these residential energy credits we see, especially over the last couple of years. Residential energy credits, people have been applying for those quite a bit lately. Other payments and credits, net premium tax credit. Again, this is the Obamacare, the Affordable Care Act is what I should be calling it probably. Net premium tax credit on Form 8962 shows up here. The amount paid with request for extension, excessive Social Security and Tier 1, railroad retirement tax withheld. So if somebody had too much tax withheld from their Social Security, they would essentially get it back here. Credit for federal tax on fuels, we don't see much of that. And that's pretty much it for other payments and refundable credits.